Before we begin, it's crucial to understand the following. The content in this video is for informational and educational purposes only. I am not a licensed financial advisor, and this presentation should not be construed as financial, investment, or trading advice. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any doubts. All strategies and case studies are shown for illustrative purposes and are not a suggestion to buy or sell any specific currency. Past performance is not indicative of future results. $6.6 trillion. That's not the budget of a small country. That's the amount of money that changes hands in the global foreign exchange market every single day. It dwarfs the stock market. It makes the crypto market look like a lemonade stand. It's the biggest, most liquid financial market on the planet. And for many Americans, it feels completely out of reach. You've seen the charts, you've heard the jargon, pips, lots, leverage. It sounds like a secret language for a club you weren't invited to. You go online, you search how to open a Forex account, and you're hit with a tidal wave of conflicting information, ads for offshore brokers promising the moon, and gurus in rented Lamborghinis telling you it's easy. But you know better. You know that for a US citizen it's different. It's more complicated. You've heard whispers about strange rules, strict regulations, and a limited number of brokers. The fear of making a mistake, of sending your hard-earned money to the wrong place, of breaking a rule you didn't even know existed. It's paralyzing. And that paralysis is the reason why countless Americans who are curious about Forex never even take the first step. This video is the antidote to that paralysis. This is your official invitation to the club, and more importantly, it's the rulebook, the roadmap, and the key, all designed specifically for citizens of the United States. We are going to cut through all the noise, all the hype, and all the confusion. By the end of this presentation, you will have a crystal clear step-by-step blueprint for opening a Forex account in the US, legally, safely, and with total confidence. We're not just going to tell you what to do. We're going to show you how to do it and explain why it's done that way. We will demystify the regulations that scare everyone else away. We will give you a powerful checklist to vet any broker. And we will walk you through the entire process, from understanding the landscape to clicking that final submit button. I remember when I first started. I spent weeks not trading, not learning, but just trying to figure out which brokers were even legal for me to use as an American. I'd find a broker with great reviews, amazing software, and then I'd dig into the fine print and see those dreaded words. Not available for US clients. It was frustrating. It felt like the rest of the world had access to this incredible market, and we were stuck on the outside looking in. I made mistakes, I wasted time, and I went down so many dead-end roads. This video is the guide I wish I had. It's built to save you that frustration, that time, and that uncertainty. So where do we start? We start by confronting the beast head-on. We need to understand why the US Forex market is so unique. The reason boils down to one major event, the 2008 financial crisis. In the aftermath, the US government passed a sweeping piece of legislation called the Dodd-Frank Act. Its goal was to prevent another meltdown by putting stricter rules on the entire financial industry, and Forex was right in its crosshairs. This act empowered two critical regulatory bodies that you absolutely need to know: the CFTC, which is the Commodity Futures Trading Commission, and the NFA, the National Futures Association. Think of the CFTC as the federal government's top financial watchdog, setting the rules of the game. The NFA is like the industry's self-policing organization, making sure all the players, especially the brokers, are following those rules. They are the sheriffs of the US Forex world. Any legitimate Forex broker that wants to accept US clients must be registered with both. There are no exceptions. This is your first and most important line of defense. If a broker is not regulated by the CFTC and a member of the NFA, you close the browser tab and you run. It's that simple. Now, these regulators put 3 specific rules in place that dramatically changed Forex trading in the US, and these are the rules that cause the most confusion. Let's break them down right now. First is the leverage cap. In many parts of the world, brokers can offer insane leverage like 500 to 1 or even 1,000 to 1. This means for every $1 you have, You can control $1,000 in the market. It sounds amazing, but it's a double-edged sword that can wipe out an account in seconds. The US regulators saw this as incredibly risky for retail traders, so they capped it. For major currency pairs like the euro versus the US dollar, the maximum leverage you can get is 50-1. For minor pairs, it's 21. Now, a lot of people online complain about this. They see it as a limitation. I want you to reframe that. This isn't a limitation. It's a protection. It's a mandatory seatbelt and airbag system for your trading account. It forces you to be more disciplined with your capital and prevents the kind of catastrophic losses that are all too common in unregulated environments. The second rule is the one that trips up everyone, the FIFO rule. It stands for first in, first out. It sounds complicated, but the concept is simple. Imagine you're in line at the grocery store. You can't just decide to let the person behind you go first. The first person in line must be the first person to check out. FIFO in trading works the same way. If you buy a currency pair at one price, and then the price drops and you buy it again, you create two separate positions. If you then decide to sell one of those positions, the FIFO rule dictates that you must sell the first one you bought. You don't get to pick and choose. You have to close your trades in the order you open them. This brings us to the third rule, which is directly related. No hedging. Hedging is when you are simultaneously long and short the same currency pair. For example, you buy the euro to US dollar, and then you also sell the euro to US dollar at the same time, hoping to profit regardless of which way the market moves. In the US, this is not allowed. Because of the FIFO rule, if you were to buy the pair and then sell it, the sell order would simply close out your initial buy order. You can't have two opposing positions open on the same pair at the same time. So let's recap the American landscape. Brokers must be regulated by the CFTC and NFA. Leverage is capped at 50-1 for majors. And the FIFO rule means you can't hedge and must close trades in the order they were opened. Hearing all of this, you might be thinking, wow, that sounds restrictive. Why would I even want to trade in the US? And that is the billion-dollar question. The answer is security, trust, peace of mind. Those rules aren't walls designed to keep you out. They are guardrails designed to keep you safe on the financial highway. When you use an NFA-regulated broker, you have a powerful regulator on your side. Your funds are required to be held in segregated accounts at top-tier banks, meaning the broker can't just take your money and use it for their own operations. There are strict capital requirements, transparent pricing rules, and a clear legal framework for resolving disputes. You are trading in one of the most secure, most transparent, and most well-regulated environments on the entire planet. While traders in other countries might be lured by high leverage and fancy bonuses from offshore brokers, they are also operating with no safety net. If that broker disappears overnight, their money is gone, forever. As a US trader, you are afforded protections that are the envy of the retail trading world. Understanding this landscape is the foundational first step. It's the context for everything that comes next. You now know the rules of the playground. You understand why it's different here. You've shifted your mindset from seeing these regulations as a burden to seeing them as a shield. With this knowledge, you are already ahead of 99% of aspiring traders in the US. So the next logical question is, now that I know the rules, how do I find a team? How do I find a broker that not only follows these rules to the letter, but is also the absolute best fit for my personal trading style and goals? Because they are not all created equal. Some have lower spreads, some have better trading platforms, and some have superior customer service. Choosing the right one is the single most important decision you will make in your trading journey. And in the next section, we are going to build the ultimate broker selection checklist. We'll cover the non-negotiable criteria every broker must meet, and then dive into the finer details that separate the good from the great. We're moving from the why to the who. So let's get straight to it. Choosing a Forex broker is, without exaggeration, the single most important decision you will make in your entire trading career. It's more important than your strategy, more important than your risk management, and more important than the currency pairs you choose to trade. Why? Because your broker is your partner. They are the gatekeeper to the market. Choosing the wrong one is like trying to win the Indianapolis 500 with a rusty engine seized up with sludge. It doesn't matter how skilled of a driver you are. You're not even leaving the pit lane. A great broker, on the other hand, is like a finely tuned high-performance engine. It gives you the power, reliability, and precision you need to execute your plan. Our checklist is broken into two sections. First, the absolute, ironclad non-negotiables. If a broker fails even one of these checks, you close the browser tab and never look back. Period. The first and most critical non-negotiable is regulation. Specifically, regulation within the United States. In the world of finance, the US is a fortress. The regulatory hurdles are high, the rules are strict, and the penalties for breaking them are severe. This is fantastic news for you as a trader. It means the brokers who are legally allowed to operate here have been put through the ringer. The two agencies you need to burn into your memory are the CFTC, the Commodity Futures Trading Commission, and the NFA, the National Futures Association. Think of the CFTC as the federal government's top cop for the derivatives markets, which includes Forex. They write the big rules. The NFA is the self-regulatory organization that enforces those rules on the ground level. They're the ones who handle broker registration, conduct audits, and ensure everyone is playing fair. Any legitimate U.S. Forex broker must be registered with the CFTC and be a member of the NFA. There is no gray area here. How do you check? Surprisingly easy. The NFA has a public database called BASIC, that's BSIC, for Background Affiliation Status Information Center. You can go to the NFA website, type in the broker's name, and see their entire regulatory history. If they're not in that database, they are not a legitimate U.S. broker. End of story. Now, you will inevitably come across brokers based offshore, in Cyprus, the Caribbean, or some remote island, promising you the world. They'll offer insanely high leverage, massive bonuses, and a trading experience free from those pesky US rules. Run as fast as you can. Trading with an unregulated offshore broker is the financial equivalent of handing a suitcase full of cash to a stranger in an alley. There is no recourse. If they decide to freeze your account, manipulate your trades, or simply disappear with your money, there is nothing the US authorities can do for you. The high leverage they offer isn't a feature. It's bait. They know that statistically, most traders using extreme leverage will lose their money faster, and that money often goes directly into the broker's pocket. Stick to the fortress. Stick with CFTC and NFA regulation. The second non-negotiable is the security of your funds. You need to know that your hard-earned capital is safe. The key phrase you are looking for is segregated client accounts. This is a regulatory requirement in the US, but you need to see it stated plainly. It means the broker must keep your money in a separate bank account from their own operational funds. They cannot use your trading capital to pay their rent, their salaries, or their marketing bills. Why is this so important? Because if the broker goes bankrupt, your money isn't commingled with their assets. It's protected from their creditors. It's your money held in trust for you. It's like having a safe deposit box at a bank. Even if the bank itself has financial trouble, the contents of your box are still yours. Without segregated accounts, you're just another creditor in a long line, hoping to get pennies on the dollar. Also, look for standard digital security features like two-factor authentication or 2FA to protect your account from unauthorized access. This should be standard practice in today's world. Our third and final non-negotiable is platform stability. Your trading platform is your cockpit. It's your connection to the live, multi-trillion-dollar-a-day Forex market. It has to work flawlessly every single time. Imagine this scenario. The Federal Reserve just made a surprise interest rate announcement. The market is going absolutely wild. You're in a trade that's rapidly moving against you, and you need to get out now to cut your losses. You click the close button, and a spinning wheel appears. The platform has frozen. By the time it reconnects, seconds or even minutes later, your manageable loss has turned into a catastrophic one. This isn't a hypothetical. It's a trader's nightmare. You need a platform with rock-solid uptime and lightning-fast execution. Most US brokers offer a choice between their own proprietary platform and the industry standards MetaTrader 4 or MetaTrader 5, often called MT4 and MT5. MT4 is the old, reliable workhorse of the industry, with a massive library of custom indicators and automated trading robots, known as expert advisors. MT5 is its more modern successor with more features. Proprietary platforms, built by the brokers themselves, often have a sleeker design and unique tools, but you're locked into that broker's ecosystem. The key is to test it. Open a demo account and put the platform through its paces. Does it lag? Does it disconnect? Is it intuitive? Don't just trade on it when the market is quiet. Try using it during a major news release to see how it performs under pressure. Okay, so we have our foundation, US regulation, segregated funds, and a stable platform. A broker that meets these three criteria is safe. But we're not looking for safe. We're looking for optimal. Now we move into the finer details that separate the good from the great. These are the factors that directly impact your profitability and your day-to-day trading experience. First up, the cost of trading. Spreads and commissions. Every time you place a trade, you pay a small fee. This is how the broker makes money. This cost comes in two primary forms. The first is the spread. The spread is simply the tiny difference between the buy price and the sell price of a currency pair. If you can buy the euro to US dollar at 1.0701 and sell it at 1.0700, the spread is 1 pip. That 1 pip is the broker's revenue. The second model is commission-based. Here you might get access to the raw spread from the market, which can be close to zero, but you pay a fixed commission for every trade you open and close, say $5 per 100,000 units traded. Neither model is inherently better. It depends on your trading style. Scalpers and high-frequency traders who get in and out of the market very quickly often prefer the commission model because they need the tightest spreads possible. Swing traders or position traders who hold trades for days or weeks might be less sensitive to a slightly wider spread and prefer the simplicity of a commission-free account. The crucial thing is to be aware of the true cost. Don't be fooled by marketing that screams spreads as low as zero. Look for the typical or average spread during normal market hours. A broker that's transparent about its average spreads is one that respects its clients. Next, we wade into slightly more technical but critically important territory: the broker's execution model. This is about how your trade is actually filled. Broadly, there are two types: dealing desk, also known as a market maker, and no dealing desk. A dealing desk broker literally creates a market for its clients. When you buy, they are the seller. When you sell, they are the buyer. This can lead to a potential conflict of interest, as your loss is technically their gain. However, reputable market makers in a highly regulated environment, like the US, still have an obligation to provide fair pricing. The alternative is a no-dealing desk model, which includes STP, straight-through processing, or ECN, electronic communication network. In this model, the broker acts as a bridge, passing your order directly to a network of liquidity providers, big banks and financial institutions, who compete to fill your order at the best possible price. This model is generally considered more transparent. Why does this matter to you? It all comes down to execution quality. You want your orders filled at the price you clicked, or as close to it as possible with minimal delay. The difference between the price you expect and the price you get is called slippage. In a fast-moving market, some slippage is unavoidable, but a good broker with a robust execution model will minimize it. Their job is to get you the best fill possible, whether they are a market maker or an ECN bridge. So we've built the core of our checklist. We know to demand NFA and CFTC regulation. We know our funds must be segregated and secure. We need a trading platform that is as reliable as a Swiss watch. And we understand how to analyze the costs and execution quality that will shape our trading performance. These are the pillars of a sound choice. But we're not done yet. The structure is built, but now we need to furnish it. And the furniture we choose will define our entire experience. It's the difference between an empty, echoing room and a command center perfectly tailored to our goals. The single most important piece of furniture, the one you'll be interacting with every single day, is your trading platform. Think of it as the cockpit of your entire trading operation. It's the dashboard, the steering wheel, and the windshield all in one. If it's clunky, slow, or confusing, it doesn't matter how great the engine underneath is. You're going to have a frustrating and potentially costly ride. In the world of US Forex trading, you'll generally encounter two main categories of platforms. First, you have the titans of the industry, MetaTrader 4 and MetaTrader 5, commonly known as MT4 and MT5. For years, MT4 has been the undisputed king. It's the Ford F-150 of trading platforms. Not necessarily the flashiest, but it's incredibly reliable, universally understood, and has a massive aftermarket of tools and add-ons. Its biggest strength is its ecosystem. Thousands of developers have created custom indicators, scripts, and automated trading strategies called expert advisors, or EAs, for it. If you've ever wanted to test or deploy an automated strategy, chances are you've encountered MT4. MT5 is its newer, more powerful sibling. It offers more time frames, more built-in indicators, and is better suited for trading other markets like stocks and commodities in addition to Forex. While broker adoption was slow at first, it's now becoming a new standard. Choosing between them often comes down to the specific tools you need and what your chosen broker supports. The second category is the proprietary platform. These are the custom-built cockpits designed by the brokers themselves. Think of Thinkorswim by TD Ameritrade, or the dedicated platforms from Forex.com and OANDA. The advantage here is seamless integration. Everything from charting to account management to news feeds is built to work together perfectly within that broker's ecosystem. They often have unique features, incredibly intuitive interfaces, and fantastic mobile apps that are a joy to use. The trade-off? You're in a walled garden. The skills and layouts you master on a proprietary platform don't transfer to other brokers. There's also a smaller community for custom tools compared to the vast world of MetaTrader. There is no right or wrong answer here. The best platform is the one that feels like an extension of your own mind. It should disappear into the background, allowing you to focus on the market, not on fumbling for the right button. Before you commit a single dollar, open a demo account and live in the platform for a week. Test its charting tools. Place a dozen fake trades. See how it performs under pressure. Does it feel intuitive? Is it fast? Does it empower you or frustrate you? That's the only test that matters. Once you've settled on your command center, it's time to choose your account type. This isn't just a trivial detail. It's a decision that fundamentally shapes your risk management and potential trading style. Think of it like choosing your gear for a mission. You wouldn't take the same equipment for a long-range reconnaissance mission as you would for close-quarters combat. For most beginners and even many experienced traders, the most important distinction is the trade size a broker allows. This is where you'll hear terms like standard, mini, and micro lots. A standard lot in Forex represents 100,000 units of the base currency. For a beginner, trading standard lots with a small account is financial suicide. It's like learning to drive in a Formula One car. The slightest mistake gets magnified into a catastrophic crash. This is why mini lots, which are 10,000 units, and especially micro lots at just 1,000 units, are so incredibly important. Trading with micro lots allows you to control your risk with surgical precision. It lets you test strategies with real money on the line, but with stakes that won't wipe out your account if you're wrong. It's the difference between learning to swim in a calm, shallow pool versus being thrown into the middle of the ocean. Always check that your broker offers micro lots, especially when you're starting out. You might also see accounts described by their execution model, like standard versus ECN. A standard account, often run by a broker acting as a market maker, typically features zero commission but slightly wider spreads. The broker makes its money from that spread, the small difference between the buy and sell price. An ECN, or electronic communication network, account is different. It routes your orders directly to a network of liquidity providers, banks, institutions, and other traders. The result is often razor-thin, variable spreads. But you'll pay a fixed commission on every trade you open and close. Which is better? It depends on your strategy. High-frequency scalpers who get in and out of the market dozens of times a day often prefer ECN accounts because the lower spread, even with a commission, can result in lower overall costs. For a swing trader holding positions for days or weeks, the simplicity of a commission-free standard account might be more appealing. Now we arrive at the most misunderstood, most powerful, and potentially most dangerous tool in your entire arsenal: leverage. In the United States, Forex leverage is strictly regulated for retail traders. The maximum is 50-to-1 for major currency pairs like the euro versus the US dollar, and 20-to-1 for minor pairs. This means for every $1 of your own money, your broker can lend you up to $50 to control a much larger position in the market. This regulation was put in place to protect you. Before these rules, brokers offered insane leverage levels of 200-to-1, 400-to-1, even 1,000-to-1, which caused countless traders to blow up their accounts with breathtaking speed. Leverage is a power tool. In the hands of a skilled craftsman, it can build incredible things. In the hands of a novice, it can cause devastating injury. It amplifies everything. A 1% move in the market doesn't just mean a 1% gain or loss on your capital. With 50-to-1 leverage, that 1% move becomes a 50% gain or loss on your capital. It's exhilarating when a trade goes your way, and absolutely crushing when it doesn't. The mechanism that makes this possible is called margin. Margin is not a fee, it's a good faith deposit. It's the amount of your own money that your broker requires you to set aside to open and maintain a leveraged position. For example, to control a $50,000 position with 50-to-1 leverage, you would need to put up $1,000 of your own money as margin. That $1,000 is now used margin. The rest of your account balance is usable margin, which can be used to cover any losses or to open new positions. But what happens if your trade starts to lose money? As the loss grows, it eats into your usable margin. If the losses become so large that they threaten to wipe out your entire account balance, you'll face the dreaded margin call. This is your broker's automated risk management system kicking in. They will automatically close some or all of your losing positions to prevent your account from going into a negative balance. They are protecting themselves and by extension you from catastrophic loss. But it's a brutal process. It happens at the worst possible time, locking in your losses. Understanding how leverage and margin work isn't just recommended. It is the absolute prerequisite for survival in this market. Never use more leverage than you need, and always understand your risk on every single trade before you click the button. Finally, let's talk about the last piece of furniture. Your lifeline. Customer support. It's the one thing you hope you never have to use, but when you do, its quality can be the difference between a minor inconvenience and a major disaster. The Forex market runs 24 hours a day, 5 days a week. Your broker's support should too. Imagine it's 3 a.m. on a Wednesday, London session is in full swing, and a major news release has just hit the wires. The market is moving violently, and your platform freezes. You have a massive open position. What do? This is when you need to be able to pick up the phone or open a live chat and get a competent human being on the line instantly. Test them out. Before you even fund your account, call their support line. Send them an email with a few technical questions. Start a live chat. How quickly do they respond? Are they knowledgeable and helpful, or are they just reading from a script? A broker who invests in quality, accessible customer support is a broker who values their clients. So now the room is furnished. We've chosen our command center, the platform. We've selected our operational gear, the account type. We've learned to respect our most powerful tool, leverage. And we've established our emergency hotline, customer support. The blueprint is complete. We know exactly what we're looking for in a US Forex broker. All the theoretical work, the deep analysis is done. Now it's time to pick up the tools and start building. We're moving from theory to action. And that action starts right now. Let's open up a browser. The first step in turning theory into reality is to build our shortlist. In many countries, this list of potential Forex brokers could be dozens long. A confusing sea of options. But here in the United States, our highly regulated environment makes this step much simpler. The list of reputable NFA-regulated brokers that offer Forex to retail clients is incredibly small. You're essentially looking at a handful of major players. For the sake of our deep dive analysis, we're going to focus on two of the most prominent names that you'll encounter again and again in your research: OANDA and Forex.com. By putting these two industry giants under the microscope, using the blueprint we just created, you'll gain the skills to analyze any US broker you come across. Let's start with our first case study. We're going to navigate to their website, but we are not going to take anything they say at face value. Remember rule number 1 from our blueprint? Regulation is non-negotiable. So before we even look at their flashy marketing, their promise spreads, or their platform demos, we are going to do our own independent verification. This is the step that 99% of beginners skip, and it's the most important. Open a new tab and search for the NFA Basic System. BASIC stands for Background Affiliation Status Information Center. This is the public database of every firm and individual registered with the National Futures Association. It's the ultimate source of truth. Once you're on the basic search page, you'll see a field for NFA ID or firm name. We'll type in ONDA Corporation. The search results pop up and we click on their name. Instantly, we have a treasure trove of information. We can see their NFA ID number. We can see their principal place of business is in New York. And most critically, we see the words NFA member approved and registered with CFTC. This is our green light. This simple 2-minute check is your shield. It confirms you are dealing with a legitimate entity under US regulatory oversight. Okay, with that crucial step complete, now we can go back to their website and analyze their offerings. We're looking through the lens of our blueprint. First up, trading platforms. We can see they offer their own proprietary platform, often just called the OANDA Trade Platform, available on web, desktop, and mobile. They also offer the globally recognized MetaTrader 4, or MT4. This presents our first major decision point. A proprietary platform is often designed for ease of use, and might be more intuitive for a complete beginner. It's built from the ground up by the broker, so everything is seamlessly integrated. On the other hand, MT4 is like the industry-standard third-party software. The benefit is that if you learn MT4, You can use that same platform with many different brokers around the world, should you ever move or your needs change. It's also famous for its massive community and a huge marketplace for automated trading programs, known as expert advisors. For a beginner, starting with the broker's own platform is often the path of least resistance. Next, let's hunt for the most important numbers: the cost of trading. We're looking for a page on their site labeled pricing, spreads, or trading costs. Here we go. We see a table of currency pairs and their associated spreads. It might say something like Euro to US dollar with a spread of as low as 1.4 pips. Let's decode that. A pip is the smallest unit of price movement in a currency pair. For most pairs, it's the fourth decimal place. The spread is the tiny difference between the buy price and the sell price. This is the broker's primary fee. So a spread of 1.4 pips on Euro to US dollar means that the moment you enter a trade, the market has to move 1.4 pips in your favor just for you to break even. This is why lower spreads are better. It means your cost of doing business is lower on every single trade. They also clarify they have no additional commissions on their standard account. It's all built into the spread. This is simple and transparent, which is a huge plus for beginners. What about account types and minimums? A quick look at their account types page shows a standard account and a premium account. The premium version often requires a much larger deposit, but offers tighter spreads. As a new trader, the standard account is where you'll be starting. We look for the minimum deposit. It appears they have no minimum deposit requirement to open an account. This is a massive point of flexibility. It means you can start with a very small amount of capital to test the waters, which aligns perfectly with a risk-conscious approach. Finally, we look for educational resources and customer support. A deep dive into their site reveals a robust Learn section with articles, tutorials, and platform guides. Their support page lists phone numbers and a live chat option during business hours. This checks the final boxes of our blueprint. So for our first broker, we verified their regulation, understood their platform choices, decoded their pricing, confirmed their accessible account minimums, and seen evidence of strong support. Now let's rinse and repeat. We're not making a decision yet. We're gathering intelligence. Let's move to our second case study, Forex.com. Same process, no shortcuts. First, we go back to the NFA basic system. We type in Forex.com, or their parent company name, Gain Capital Group. Again, the results come back clean. NFA member approved, registered with CFTC. Green light number 2. Now to their website. Let's analyze it against the same blueprint criteria. First, platforms. This is interesting. We immediately see a key difference. Like the first broker, they offer their own proprietary platform in MetaTrader. But they also offer a more advanced platform, sometimes with features like direct market access or more sophisticated charting tools. This tells us they might cater to a wider range of traders, from beginners to the very advanced. For a new trader, this might be information overload, or it could be seen as a platform you can grow into over time. Next, let's find the pricing. We navigate to their trading costs page. We see a similar table of spreads. Let's compare the Euro to US dollar. Maybe their spread is also listed as low as a certain number, say 1.3 pips. It's competitive, but then we see something else, different account types with different pricing structures. They might offer a standard account, which is spread only, just like our first case study. But they also might offer a commission account. This is a crucial distinction. In a commission account, the raw spread you get from the market is much tighter, sometimes close to zero. However, you pay a flat, fixed commission fee for every trade you place, for example, $5 per 100,000 units of currency traded. So which is better? There's no single answer. The spread-only model is simpler to understand. The commission model can, in some cases, be cheaper for very active traders or those trading larger sizes, as the cost is more fixed. For a beginner making smaller trades, the simplicity of the standard, spread-only account is often the recommended starting point. Now for account minimums. We check their account types page. Let's say their recommended minimum deposit for a standard account is $100. This is still very accessible, but it's a different approach than the no minimum policy of our first case study. It's a small barrier to entry, but a barrier nonetheless. Finally, we examine their educational and support infrastructure. They too have a vast library of content, market analysis, and webinars. They offer robust customer support. In this regard, both brokers are highly competitive, understanding that educating their clients is good for business. So now we have two complete intelligence reports. We've moved from a theoretical blueprint to a practical comparison of two legitimate, US-regulated brokers. The choice isn't about which one is objectively the best. It's about which one aligns with your personal blueprint. Let's create a quick decision matrix. If your absolute top priority is the lowest possible barrier to entry and a simple, clean platform to get started, Broker One's no minimum deposit policy and intuitive proprietary platform might appeal to you more. If you see yourself eventually becoming a more advanced trader, and you value having access to multiple sophisticated platforms and different pricing models to choose from down the line, Broker 2 might be the more strategic long-term choice. Do you prefer the all-in simplicity of a spread-only model, or does the idea of a commission-based account with tighter raw spreads intrigue you? This is the process of making an informed decision. It's not about a gut feeling. It's about methodical research, direct comparison, and aligning the facts with your personal goals and starting point. For the purpose of this step-by-step walkthrough, we need to choose one to proceed with for the actual application process. Based on a hypothetical beginner profile that prioritizes simplicity, a user-friendly interface, and the lowest possible financial barrier to entry, we're going to move forward with the broker that offers the most straightforward path. Remember, your choice might be different based on your own analysis, and that is exactly the point of this exercise. You are now equipped to make that choice for yourself. The reconnaissance is over. The decision for this demonstration is made. In the next part, we are going to take the final leap. We will go to the chosen broker's website, and we are going to click that Open Account button. We will walk through every single field, every document upload, and every compliance question together. The last administrative hurdle before you can access the market is right around the corner. Alright, let's dive in. As soon as you click that button, you're taken to the application itself. It might look a little intimidating, like filing your taxes for the first time, but I assure you, it's straightforward once you understand why they're asking each question. This isn't just busy work. Every single field is there for a reason, usually tied to federal regulations designed to protect both you and the brokerage. The first section is almost always your personal information. This is the easy part. You'll enter your full legal name, your date of birth, and your residential address. A quick but critical tip here: use the exact name and address that appear on your government-issued ID and your utility bills. A tiny mismatch, like using street instead of street, or forgetting a middle initial, can sometimes trigger a manual review and slow down your approval. It's a small detail that can save you a headache later. Next, you'll see a field for your social security number or taxpayer identification number. This is a point where many people pause, and for good reason. We're all taught to guard that number carefully, so why do they need it? This is a non-negotiable requirement under the Patriot Act and Know Your Customer, or KYC regulations. It's the primary way brokers verify your identity with the US government to prevent things like money laundering and financial crime. A regulated, US-based broker is legally obligated to ask for this. In fact, if a broker doesn't ask for it, that's a massive red flag. Reputable firms use bank-level encryption to protect this data, so you can be confident it's secure. Once you've filled out the basics, you'll move on to the financial information section. This is where the questions get a bit more personal, and it's also where people tend to get a little uncomfortable. You'll be asked for your approximate annual income, your estimated net worth, and your liquid net worth. Let's break these down. Annual income is simple enough. Net worth is the total value of everything you own: your house, car, investments, savings, minus all your debts like your mortgage or loans. Liquid net worth is a subset of that. It's the value of assets you can convert to cash quickly. Think stocks, cash in the bank, or mutual funds, but not your primary home or retirement accounts. Why do they need to know this? It's not to judge you. It's for a regulatory concept called suitability. Forex trading, especially with leverage, involves significant risk. Regulators like the Commodity Futures Trading Commission, or CFTC, require brokers to make a good faith effort to ensure that their clients are in a financial position to handle the potential losses. They need to see that you're not betting your rent money. Think of it like a doctor asking about your health history before prescribing a powerful medication. They need the full picture to ensure your safety. There's no magic number you need to have here. Be honest. Inflating your numbers could lead to you being approved for a level of risk you're not actually prepared for, which is the last thing you want. Honesty on this form is a tool for your own protection. The next section is equally important: your trading experience. The application will ask you about your experience with different financial products, stocks, options, futures, and of course Forex. It'll ask how many years you've been trading and maybe the approximate number of trades you place per year. Again, this is all part of the suitability assessment. They are trying to gauge your level of sophistication as an investor. This is the moment to do a frank self-assessment. If you've been clicking around a stock trading app for a few months, that's great, but it doesn't make you an expert with over 10 years of experience. Be truthful. If you have zero experience, say so. This is not a test you can fail. There is no shame in being a beginner. Everyone starts there. In fact, indicating you're a novice can be beneficial. It might place you in an account category with lower leverage, more educational resources, and perhaps even more attentive customer support. All things that are incredibly valuable when you're starting out. Lying here is one of the fastest ways to get into trouble. If you claim to be a seasoned pro, the system might grant you access to the highest levels of leverage and the most complex products, assuming you know how to handle them. It's like being given the keys to a Formula One car when you've only ever driven a go-kart. Be honest about your experience level. It's the responsible thing to do for your future self. After the experience questions, you'll hit the regulatory section. This is usually a series of checkboxes and yes/no questions. One common question is, are you a politically exposed person? Or a PEP? For about 99.9% of us, the answer is no. A PEP is someone who holds a prominent public function, like a senior government official or a high-ranking military officer, or their immediate family. This is another anti-money laundering check. You'll also be asked if you or an immediate family member is an employee or director of another brokerage firm or exchange. This is to manage potential conflicts of interest. For most people, the answer will be no. Most importantly, this section will contain the risk disclosures. You'll see a series of statements and be asked to check a box confirming that you have read and understood them. Please do not just blindly check this box. At least skim through it. It will state in very clear terms that trading foreign exchange is highly speculative, carries a high level of risk, and may not be suitable for all investors. It will explicitly say that you could lose all of your initial investment and, in some cases, even more. It will remind you that past performance is not indicative of future results. By checking that box, you are providing a legally binding acknowledgement that you understand these risks. Take that acknowledgement seriously. This is the final gut check moment where you confirm you are ready to proceed with a clear understanding of the potential outcomes. Finally, we get to the document upload stage. This is where you prove you are who you say you are. You will almost always need to provide two types of documents. First, a proof of identity. This needs to be a clear, unexpired, government-issued photo ID. A driver's license or a passport are the gold standards. Second, you'll need a proof of address. This is typically a recent utility bill, like an electric, water, or internet bill, or a bank or credit card statement. The key requirements here are that the document must be recent, usually within the last 90 days, and it must clearly show your full name and the same address you used on your application. Here are some pro tips to avoid delays. Use your phone to take a clear, well-lit photo of your documents. Don't use a blurry webcam. Make sure all four corners of the document are visible in the picture. Don't crop them off. Avoid any glare on the photo, especially over your face or the text. And I'll say it again, the name and address must match your application exactly. This is the #1 reason applications get kicked back for manual review. A little care here can get your account approved in hours instead of days. Once you've filled everything out, answered every question, and uploaded your documents, you'll see a final Submit Application button. Take one last look over everything to make sure there are no typos. Then click it. Congratulations! You've done it. The administrative part is over. So what happens now? The broker's compliance team will review your application. They'll use the information and documents you provided to verify your identity and assess the suitability of the account for you. This process is usually quite fast for U.S. brokers, often taking anywhere from a few hours to a couple of business days. You'll receive an email confirming your application has been received, and then a second, more important email telling you whether you've been approved. As long as you are honest and your documents are clear, the approval process is typically smooth. That approval email is the green light. It's the final confirmation that your account is open and ready, but it's still an empty account. The next logical and absolutely critical step is to fund it, and how you do that involves its own set of choices and strategies. Funding your account is the moment the abstract becomes concrete. It's the transition from theory to practice, from being a student of the markets to an active participant. This isn't just a simple bank transfer. It's your initial stake. It's the act of moving your hard-earned capital from the safety of your bank into the dynamic, fast-paced world of the foreign exchange market. Psychologically, this is a massive step. It's the commitment. It's the point where you put skin in the game. So let's break down not just how to do it, but how to think about it strategically. Because the choices you make here will set the stage for your entire trading journey. In the United States, your funding options are clear-cut and regulated. The most common methods you'll encounter are an ACH transfer, a wire transfer, and in some cases, a debit card. You'll notice one popular option is missing: the credit card. Due to regulations stemming from the Dodd-Frank Act, U.S. brokers are generally prohibited from accepting credit cards for funding. And honestly, this is a blessing in disguise. It's a built-in safeguard that prevents you from trading with borrowed money, which is a foundational rule of responsible risk management. Never ever trade with money you don't have. Let's look at the workhorse method first: the ACH transfer, which stands for Automated Clearinghouse. This is likely the same system you use for direct deposit from your employer or for paying bills online. It's reliable, it's familiar, and it's typically free. When you go to your broker's funding portal, you'll select ACH, and it will prompt you to link your bank account. This usually involves you logging into your bank through a secure third-party service like Plaid, or by manually entering your routing and account numbers. To verify the account is yours, they might use a micro-deposit system, sending two tiny amounts like 11 cents and 23 cents to your bank. You then log back in and confirm those amounts. Once your bank is linked, you simply specify how much you want to transfer. The main consideration for ACH is time. It's not instant. It can take anywhere from 1 to 3 business days for the funds to clear and become available for trading. Think of ACH as the sensible family sedan of funding methods. It's cost-effective and gets the job done safely, but it's not built for speed. Now, if you need speed, you look to the wire transfer. This is the express courier of the financial world. Wires are the preferred method for large deposits because they often have very high or even no funding limits. And they are fast. Funds sent via wire can often be available in your trading account the very same day, sometimes within a few hours. The trade-off for this speed and capacity is cost. Your bank will almost certainly charge you a fee for sending a wire, typically anywhere from $25 to $50 for a domestic transfer. Sometimes the broker's receiving bank might even charge a fee on their end, though many brokers will absorb that cost. To do a wire, your broker provides you with their specific wiring instructions: their bank's name, the ABA routing number, their account number, and the beneficiary name. You then take this information to your bank, either in person or through your online banking portal, to initiate the transfer. It's a bit more hands-on than ACH, but for serious capital or urgent funding, it's the industry standard. The third option, which is becoming more common, is using a debit card. The appeal is obvious. It's instantaneous. You enter your card details just like you're buying something online, and boom, the money appears in your trading account within seconds. It's incredibly convenient. However, there are usually 2 major limitations. First, the funding limits for debit cards are often much lower than for ACH or wires. You might be capped at a few $1,000s per transaction or per day. Second, while many brokers don't charge a fee, some might pass on the card processing fee to you. It's also worth noting that your own bank might flag the transaction as unusual, requiring you to call them to approve it. A debit card is great for a quick top-up or for getting started with a smaller amount, but it's not typically used for initial substantial funding. So, you know the methods. But this leads to the most important question you will ask at this stage. How much should I fund my account with? This isn't a question with a one-size-fits-all answer. It is deeply personal and should be driven entirely by your financial situation and your trading plan. The absolute, non-negotiable rule is this: you should only ever fund your account with what is known as risk capital. This is money that, if it were to vanish tomorrow, would not in any way affect your ability to pay your bills, buy groceries, or maintain your standard of living. This is not your rent money. It is not your emergency fund. It is not your retirement savings. It is discretionary income set aside specifically for high-risk ventures like trading. Once you've identified your pool of risk capital, the next step is to align your funding amount with your trading strategy. A common pitfall for new traders is undercapitalization. They might think, I'll just start with $100 and see how it goes. While the intention is good, the practical reality is a nightmare. With a tiny account, the sheer mathematics of leverage and risk management work against you. Let's say you have a $200 account. Even if you're trading the smallest possible position size, a micro lot, a relatively small market move against you of just 20 pips could wipe out 10% of your entire account. The psychological pressure is immense. Every small loss feels like a catastrophe, leading to fear, emotional decision-making, and ultimately a blown account. Think of your account capital as the depth of the ocean beneath your ship. A well-capitalized account is like a large vessel in deep water. It can withstand the inevitable storms and waves, the losing trades, without sinking. An undercapitalized account is like a tiny raft in a shallow puddle. The slightest disturbance can run you aground or capsize you. Your funding amount needs to be large enough to properly implement your risk management rules. A widely discussed guideline in trading communities suggests risking no more than 1 to 2% of your account on any single trade. If you fund your account with $200, 1% is just $2. It becomes incredibly difficult to structure a trade with such a small risk tolerance. However, with an account of, say, $5,000, 1% is $50. This gives you far more flexibility to set appropriate stop losses and survive the normal ups and downs of the market without being emotionally compromised. So, before you type a number into that deposit box, look at your trading plan. What pairs will you trade? What is your strategy's historical drawdown? How much room do you need for your trades to breathe? The amount you fund is not just a deposit, it's a tool. It is the raw material that allows your strategy to function. Fund your account in a way that gives your strategy a fighting chance. When you're ready, the process is straightforward. You'll log into your broker's client portal, find the deposit or funding section, and select your chosen method. Let's say you choose it. You'll select your linked bank account, enter the amount, and click Submit. You'll get a confirmation screen and an email, and then you wait. For the next day or two, you'll be logging in, checking to see if the funds have arrived. And then it happens. You log in, and the balance that once read zero now shows your deposited amount. The money is there. It's real. Your account is live, funded, and connected to the largest financial market in the world. It's a moment of truth, a mix of excitement and a healthy dose of respect for what lies ahead. You have the key and you've put gas in the car, but you still don't know how to drive it. The next step is to get behind the wheel, to open up the trading platform for the first time and confront the dizzying array of charts, buttons, and numbers that will soon become your new digital workspace. This is it, the moment you first launch the software. It can feel like stepping onto the bridge of a starship for the first time. Flashing lights, scrolling numbers, grids and lines that seem to have a language all their own. Take a breath. It's not as complicated as it looks. In fact, most professional trading platforms, whether it's the famous MetaTrader or a broker's proprietary software, are built around 4 main areas. Let's break them down one by one and turn this chaos into a command center. First, look to the side, usually the left. You'll see a list of symbols like Euro to US dollar, Pound sterling to Japanese yen, and US dollar to Canadian dollar. This is your Market Watch window. Think of it as your menu of available markets. Each line is a currency pair, and next to it you'll see 2 prices constantly flickering. These are the bid and the ask price. The bid price is what the market is willing to pay for the currency pair. It's the price you get if you are selling. The ask price is what the market is asking for the pair. It's the price you pay if you are buying. Notice that the ask price is always slightly higher than the bid price. That tiny difference is called the spread. The spread is how the broker makes their money. It's their fee for facilitating the trade. So, when you open a new position, you'll always start at a small, immediate loss equal to the size of the spread. That's the cost of doing business, and it's a critical number to be aware of. A smaller spread means a lower transaction cost for you. Now let your eyes drift to the largest, most dominant part of your screen, the chart. This is the heart of your trading universe. It's a visual story of price over time. The vertical axis, the y-axis, represents the price. The horizontal axis, the x-axis, represents time. As time moves from left to right, the chart paints a picture of the battle between buyers and sellers. You'll typically see 3 types of charts, but one is far more important than the others. A line chart is the simplest, just connecting the closing prices over a period to form a single line. A bar chart is a bit more detailed, showing the opening, high, low, and closing price for a period. But the one you need to master is the candlestick chart. Each one of those little red and green rectangles is a candle, and each candle tells a rich, 4-part story of a specific time period. Let's dissect one. The thick, colored part is called the body. It shows you the difference between the opening price and the closing price for that period. If the candle is green or sometimes white or blue, it means the price closed higher than it opened. Buyers were in control. We call this a bullish candle. If the candle is red or sometimes black, it means the price closed lower than it opened. Sellers were in control. This is a bearish candle. Then you have the thin line sticking out from the top and bottom of the body. These are called wicks or shadows. The very top of the upper wick shows the absolute highest price reached during that time period, and the very bottom of the lower wick shows the absolute lowest price. So, in one single shape, a candlestick gives you the open, the high, the low, and the close. It's an incredibly efficient way to see market sentiment at a glance. Seeing a long upper wick, for example, tells you that buyers tried to push the price way up, but sellers pushed it right back down before the period ended. That's a story the line chart could never tell you. Look closer at the chart window and you'll see tabs like M1, M5, H1, H4, D1. These are time frames. M1 means each candle on the chart represents 1 minute of price action. H1 means each candle represents 1 hour. D1 means each candle is 1 full day. Zooming in and out between these time frames is like looking at a coastline from a satellite versus standing on the beach. From space, you see the major trend, the overall shape of the coast. On the beach, you see every individual wave crashing on the shore. Both perspectives are essential. Professional analysis often involves looking at a higher time frame to establish the primary trend, and then zooming into a lower time frame to find precise entry and exit points. Okay, let's move to the third section, often tucked away below the market watch. This is the navigator window. This is your file cabinet. It's where you can quickly switch between different trading accounts like your demo and, eventually, your live account. It's also home to your technical indicators. These are mathematical calculations based on price or volume, like moving averages or the relative strength index, that you can overlay on your chart to help with analysis. We're not diving deep into those now, but this is where they live. You'll also find folders for expert advisors, which are automated trading programs, and custom scripts. For now, just know this is your toolbox for adding advanced tools to your chart. Finally, the fourth and final section, usually at the very bottom of the screen, is the terminal or toolbox. This is your dashboard for everything happening with your account. It has several tabs. The most important one is the Trade tab. This is where you'll see all your open positions in real time. You can watch your profits or losses tick up and down. Next to it is the Account History tab. This is your trading journal, a permanent record of every single trade you've ever closed, showing your wins, your losses, and your overall performance. This tab is where you learn from your mistakes and analyze your successes. It's a goldmine of personal data. So we have the menu Market Watch, the Story Chart, the Toolbox Navigator, and the Dashboard Terminal. Now that we know the layout, it's time to do something. It's time to place our first trade. And I cannot stress this enough. We are doing this on your demo account. This is flight simulator time. We're using fake money to learn real skills without any real-world risk. Find the New Order button. A window will pop up, and this is your trade ticket. Let's walk through the fields. First is symbol, which is the currency pair you want to trade, like euro to US dollar. Next, and this is critically important, is volume. This refers to the size of your trade, measured in lots. A standard lot is 100,000 units of the base currency. This is typically for institutional traders. For retail traders, we have mini lots, 10,000 units, and micro lots, 1,000 units. As a beginner, you should be thinking exclusively in micro lots. Starting small is not just a suggestion. It's a core principle of capital preservation. Choosing your position size is one of the most important decisions in risk management. Now for the two most important fields on this ticket: stop loss and take profit. A stop loss is an order you place to automatically close your trade if the price moves against you by a certain amount. It's your safety net. It's the predetermined point where you say, I was wrong on this one, and I'm getting out before the loss gets any bigger. Trading without a stop loss is like driving a race car without brakes. It might be thrilling for a moment, but it's a recipe for a catastrophic crash. Take profit is the opposite. It's an order to automatically close your trade when the price reaches a certain profit target. It helps you lock in gains and removes the emotion of greed from the equation, preventing you from holding on too long and watching a winning trade turn into a loser. Finally, you'll see the type of order. For now, we'll focus on market execution, which means you want to buy or sell at the current best available price right now. Then you have the big buttons, a blue one for buy and a red one for sell. If your analysis suggests the price of the euro is going to go up against the US dollar, you would click buy. If you think it's going to go down, you click sell. So let's do it. On your demo account, select euro to US dollar. Set the volume to 0.01, which is 1 micro lot. Set a reasonable stop loss below the current price for a buy, or above for a sell. Set a take profit, and then click the button. Just like that, you've placed a trade. Look down at your terminal window in the Trade tab. There it is. Your first position. It's live. It's active. You're no longer just an observer watching the charts. You are a participant in the global foreign exchange market. Even with demo money, that feeling is different. The numbers on the chart are no longer abstract. They are directly tied to an outcome you are a part of. This is the fundamental shift. You've moved from theory to practice, and now the real learning can begin. And at this exact moment, you are at the most dangerous and the most pivotal point in your entire trading journey. Because as you watch that tiny position, that 10,000th of a lot fluctuate up and down, you will feel something you never felt in the demo account. A genuine visceral connection to the outcome. When the number is green, there's a jolt of excitement, a feeling of, I was right. When it's red, even by a few cents, a knot forms in your stomach. A little voice whispers, what if I was wrong? Maybe I should just get out. This is the battleground. It's not fought on the charts. It's fought in the 6 inches between your ears. Every new trader faces 2 primary enemies here. The impulse to snatch a tiny profit the second a trade goes green, out of fear it will reverse, and the impulse to hold on to a losing trade, praying it will turn around, because closing it would mean admitting you were wrong. Fear and greed. They aren't just market concepts. They are the puppet masters of the unprepared trader. So how do you fight them? You don't. You can't. You're human. Instead, you make decisions before they show up to the party. You use the tools the platform provides to enforce the plan your logical, calm, analytical brain made before you ever click the buy or sell button. And the 2 most important tools in your entire arsenal are the stop loss and the take profit orders. Let's break this down, because understanding this isn't just important, it is the only thing that separates those who have a chance from those who are just gambling. A stop loss order is an instruction you give your broker to automatically close your trade if the price moves against you to a specific, predetermined level. Think of it as your emergency eject button. Before you even enter the cockpit, you decide the exact point at which the mission is a failure and you need to get out to fly another day. This is not optional. Trading without a stop loss is like driving a race car without brakes. It might feel exhilarating for a moment, but the end is inevitable and it will not be pretty. The number 1 mistake beginners make with stop losses is thinking of them as an admission of failure. They see it as the point where I lose money. That's the wrong frame. A stop loss is your cost of doing business. It is the calculated, acceptable risk you are willing to take to see if your trade idea is correct. When you buy a lottery ticket, the cost of the ticket is your maximum loss. You know it up front. In trading, the stop loss defines the cost of your ticket for that specific trade. It ensures a small mistake doesn't turn into a catastrophic one. So where do you place it? It's not a random guess. A well-placed stop loss is based on your analysis. It should be at a price level that invalidates your entire reason for entering the trade. For example, if you bought the euro against the dollar because you identified a strong level of support, a price floor where the market has historically bounced up from, your stop loss would go just below that floor. Why? Because if the price breaks through that floor, your entire reason for being in the trade, the very foundation of your idea, is gone. The market has proven you wrong. And it's time to get out with a small managed loss. You don't argue with it. You don't hope it's a fake out. You accept the data, take the small loss, and look for the next opportunity. Now let's talk about the other side of the coin, the take profit order. This is the antidote to greed. A take profit is an instruction to your broker to automatically close your trade when it reaches a certain level of profit. It's you in a moment of clarity telling your future, more emotional self, this is the goal. When we get here, we're done. We take our winnings and we walk away. Why is this so critical? Because you will have winning trades that feel amazing. The price will be moving in your favor, the P&L will be a beautiful shade of green, and you'll think, maybe this is the one. Maybe this will go to the moon. Greed kicks in. You cancel your take profit target thinking you can get more. And then you watch in horror as the market reverses and your beautiful profit evaporates into nothing, or even turns into a loss. It's one of the most painful feelings in trading. A take profit order protects you from that. It enforces discipline. Just like your stop loss, it should be based on analysis. Where is the next major resistance level? Where has the market historically struggled to break through? That's a logical place to set your target. You're defining a clear objective based on market structure, not on a vague hope for infinite profit. Together, the stop loss and the take profit create your trade's framework. They define your risk and your potential reward. And this brings us to the single most important concept in all of trading, the one thing that truly separates the professionals from the amateurs: position sizing. This sounds complicated, but the core idea is simple. Position sizing answers the question, how much should I trade? And the answer is never a random number. It is always, and I mean always, a function of your stop loss. Here's the rule that many professional traders build their careers on. Risk a small fixed percentage of your account on any single trade. The most common figures you'll hear are between 1% and 2%. Let's use 1% for this example. If you have a $1,000 account, you should not be willing to lose more than $10 on any single trade. Period. This is your risk amount. It is non-negotiable. Now, how does this connect to your stop loss? Let's say you want to buy the euro to US dollar, and your analysis tells you your stop loss needs to be 20 pips away from your entry price. You know your maximum risk is $10. So the question is no longer how much should I trade? The question becomes, what position size will make a 20 pip move equal a $10 loss? Your trading platform or a simple online calculator can do this math for you instantly. You plug in your currency pair, your account currency, your stop loss distance in pips, and the percentage of your account you want to risk. It will then spit out the exact lot size you should use. It might be 0.05 lots, it might be 0.02 lots. The number itself doesn't matter. What matters is the process. This is a complete paradigm shift. You are no longer guessing. You are no longer thinking, I feel bullish, I'll buy one standard lot. Instead, you are saying, here is my trade idea. Here is the point where my idea is proven wrong. My risk will be 1% of my account. Now, calculate the position size that fits those parameters. This is how you survive. By predefining your risk on every single trade, you make it mathematically difficult to blow up your account. If you risk 1% per trade, you would need to lose 100 trades in a row to wipe out. Can you imagine that? Even with a strategy that's only right 50% of the time, the odds of losing 100 consecutive times are astronomical. This method, this simple discipline of position sizing based on a predefined stop loss, is what gives you staying power. It allows you to withstand the inevitable losing streaks and be there to capitalize on the winning ones. So, before you place your next trade, even in your live account with that tiny amount of capital, I want you to build a checklist. A pre-flight checklist, just like a pilot. Number 1. What is my reason for entering this trade? Have a clear, articulated thesis based on your analysis. Number 2. Where will my trade idea be invalidated? This is your stop-loss location. It must be based on technical or fundamental analysis. Number 3. What is my realistic profit target? This is your take-profit location. And number 4. Based on my stop-loss location and my 1% risk rule, what is my correct position size? Go through these 4 steps before every single trade. Write it down if you have to. This systematic approach starves your emotional brain of the ability to make impulsive, destructive decisions in the heat of the moment. You've already done the thinking. Now all you have to do is execute the plan. This isn't just about placing trades anymore. This is about building the foundation of a professional process. And that process is what we need to formalize next. We need to build your personal rulebook, your trading plan. This rulebook, your personal trading plan, is the single most important document you will create in your entire trading career. It's more important than the broker you choose, the platform you use, or even the initial strategy you select. Why? Because this document is your shield against your greatest enemy in the market, yourself. It's your defense against emotion, impulse, and greed. Think of a professional pilot. Does she just jump in the cockpit, fire up the engines, and hope for the best? Never. She goes through a meticulous, non-negotiable pre-flight checklist. Every single time. Your trading plan is your pre-flight checklist. It ensures that you are operating under a clear, predefined set of rules, not on a gut feeling you got while watching the news. So what goes into this critical document? Let's build it piece by piece. First, you need to define your why. This is your mission statement. It's the foundation of your entire plan. Ask yourself honestly, why are you doing this? Is it to generate a secondary income stream? To build a new skill set for the future? To achieve a specific financial goal like a down payment on a house in 5 years? Be specific. I want to make money is not a goal, it's a wish. A goal sounds like this. My objective is to achieve an average monthly return of 2% on my trading capital over the next 12 months, with the understanding that performance will fluctuate and some months may result in a loss. This will be accomplished by strictly adhering to the following plan. Your why is what you will read when you're in a drawdown, when you've had a losing streak, and when you feel like giving up. It's your anchor in the storm. Second, you define what you will trade and when. The Forex market is open 24 hours a day, 5 days a week, with dozens of currency pairs. You cannot be an expert in all of them. Trying to do so is a recipe for disaster. This is where you specialize. In your plan, you will write down the exact currency pairs you will focus on. Maybe it's just 2 or 3 major pairs to start, like the Euro/US dollar and the US dollar/Japanese yen. You need to know these pairs like the back of your hand. What are their typical daily ranges? What news events affect them most? You also define your time frame. Are you a swing trader looking at 4-hour and daily charts holding trades for a few days? Or a day trader focused on the 1-hour and 15-minute charts, closing out positions by the end of the day? Write it down. For example, I will trade only the Euro to US dollar and pound sterling to US dollar pairs. My primary analysis will be conducted on the 4-hour chart to identify the overall trend and key levels. My trade entries will be executed on the 1-hour chart. This prevents what's known as style drift, where you jump from market to market and time frame to time frame, chasing shiny objects instead of mastering your craft. Third, and this is the core of your system, you define your how. These are your exact rules for entry and exit. There can be zero ambiguity here. It needs to be so clear that a complete stranger could read your plan and execute your trades for you. This section is your strategy codified. You need to list your exact entry criteria. For instance, a long entry will only be considered if the price is above the 50-period moving average on the 4-hour chart. The 1-hour chart must then show a bullish candlestick pattern, like a hammer or an engulfing candle, at a confirmed support level. The relative strength index must be below 50, showing room for upward movement. See how specific that is. There's no room for, I think it looks good. Equally important are your exit rules. How will you get out of a trade? You need a rule for taking profits and a rule for cutting losses. The rule for cutting losses, your stop loss, is non-negotiable. It's your safety net. Your plan might say, my stop loss will always be placed 10 pips below the low of the entry candle. For taking profits, it could be, my initial take profit target will be set at a 2-to-1 risk to reward ratio. If my stop loss is 30 pips away, my take profit will be 60 pips away. You can have rules for trailing your stop or taking partial profits, but they must be written down in advance. This entire section is what transforms trading from a gamble into a systematic, repeatable process. Fourth is the section that will determine your survival. Your risk and money management rules. You can have the best strategy in the world, but without proper risk management, a string of losses can and will wipe you out. The number one rule here is defining your risk per trade. This is the maximum percentage of your account you are willing to lose on any single trade. For new traders, a common guideline is to risk no more than 1% of their account on one trade. Write it down. I will risk a maximum of 1% of my account equity on any single trade. This means if you have a $5,000 account, the most you can lose on one trade is $50. This rule single-handedly prevents you from blowing up your account on 1 or 2 bad decisions. This section also includes your position sizing calculation. Your platform doesn't know your 1% rule. You have to tell it how large of a position to open to honor that rule. The calculation is based on your account size, your risk percentage, and the distance to your stop loss. There are plenty of free online calculators for this, but the principle is simple. The further away your stop loss, the smaller your position size needs to be to maintain that 1% risk. You also need to define your maximum exposure. For example, I will not have more than 3 open trades at once, with a total combined risk not to exceed 3% of my account. This prevents you from being over-leveraged and taking a catastrophic hit if the entire market moves against you. Finally, you need to create a section on your trading routine and review process. Trading is a business and you need to set business hours. When will you do your market analysis? Sunday evening for the week ahead? Every morning for 30 minutes before the London session opens? When will you look for trades? Staring at the charts all day is a path to emotional exhaustion and bad decisions. Define your operating hours. I will analyze the markets from 7 a.m. to 7:30 a.m. Eastern Time and look for valid trade setups from 8 a.m. to 11 a.m. Eastern Time. I will not place new trades outside of this window. Part of this routine is the review. This is where you connect your trading plan to a trading journal. The plan is the theory, the journal is the record of what actually happened. At the end of each day or week, you will review every single trade you took. You'll log the entry, the exit, the profit or loss, and most importantly, you'll write down whether you followed your plan to the letter. You'll take a screenshot of the chart and note your thoughts and emotions during the trade. This journal is your feedback loop. It's the data that will tell you if your plan is working. You don't change your trading plan because you had a few losing trades. That's just part of the business. You only consider changing your plan after you've collected a significant amount of data in your journal, say 50 or 100 trades, that shows a clear statistical reason for an adjustment. This is your business plan, your constitution, your personal rulebook. It contains your mission, your markets, your strategy, your risk controls, and your daily routine. It takes time to write, and it should. You need to think deeply about every single line. Once it's done, print it out. Put it on the wall next to your computer. Before you even think about placing a trade, you read the relevant sections of your plan. Does this potential trade meet every single one of my criteria? If the answer is anything but a resounding yes, you don't take the trade. Period. No exceptions, no excuses. You have now done what 90% of aspiring traders fail to do. You've moved beyond just looking for a magic indicator or a secret strategy. You've built a professional process. You have your broker, you have your platform, you have your back-tested strategy, and now you have your rulebook. The final step is the most critical, managing the one variable that can break all the rules yourself. And that's what we'll conquer next, as we finally prepare to go live. This is it, the final piece of the puzzle. You can have the best broker, the fastest platform, and a strategy with a statistical edge proven over thousands of back-tested trades. But if you can't control the person clicking the mouse, none of it matters. The market isn't your opponent. The other traders aren't your opponents. The biggest threat to your trading account is the face you see in the mirror every morning. Mastering trading psychology isn't some fluffy, optional add-on. It is the core skill of a professional trader. Every trading mistake you will ever make stems from two primal emotions: fear and greed. They are the twin puppeteers that pull the strings of the novice trader, forcing them into catastrophic errors. Let's talk about greed first. Greed is the siren's call of the market. It's that voice in your head that whispers when a trade is going your way. Don't take profit yet. It could go higher. Imagine how much you could make. Greed makes you over-leverage, risking a huge chunk of your account on a single sure thing. It makes you add to a winning position without a logical reason, turning a good trade into a reckless gamble. It's what drives revenge trading, that burning desire to make back the money you just lost, which almost always leads to bigger, more emotional, and more devastating losses. Greed abandons the trading plan in search of a lottery ticket. It's the single biggest account killer, period. Then there's fear. Fear is just as destructive, but it operates more subtly. Fear is what makes you hesitate on a perfect trade setup that your strategy confirmed, only to watch it take off without you. This is the fear of losing. Then, as you watch the price move further and further in your intended direction, a different kind of fear kicks in, the fear of missing out, or FOMO. So you jump in late, at the worst possible price, right as the early birds are taking their profits. Fear also makes you snatch profits too early. Your plan says to target a 3-to-1 risk-to-reward ratio, but as soon as you see a little bit of green, you get scared of it turning red, so you close the trade for a tiny gain, completely destroying your strategy's statistical edge over time. You let your losers run, hoping they'll come back, and you cut your winners short, fearing they'll reverse. It's the exact opposite of what you're supposed to do, and it's all driven by fear. So how do you fight back? How do you build a psychological fortress? You do it with systems. You do it by building a process so robust that it overrides your emotional impulses. Your first line of defense is your trading journal. But I'm not just talking about writing down your entry, exit, and profit or loss. A professional's journal is an emotional logbook. For every single trade, you must write down why you took it. And I mean the real why. I took this trade because I was bored and wanted some action. I took this trade because I was angry about my last loss and wanted to make it back fast. I took this trade because it met every single one of my plan's criteria, and I was in a calm, objective state of mind. When you force yourself to write this down trade after trade, you begin to see patterns in your own behavior. You create a feedback loop that exposes your weaknesses. You can't fix what you don't acknowledge. Your journal is the mirror that forces you to acknowledge it. Your second tool is a pre-flight checklist. Just like a pilot before takeoff, you do not place a trade until you have gone through a physical or digital checklist. This is non-negotiable. What's on this list? It's your rules. For example, is the setup on a pre-approved currency pair? Check. Does it align with the higher time frame trend? Check. Has the specific entry signal from my strategy appeared? Check. Have I calculated my position size based on the 1% risk rule? Check. Have I set my stop loss and take profit levels in the platform? Check. And the final, most important item, am I emotionally neutral right now? If the answer to any of these questions is no, you do not take the trade. You close the laptop and you walk away. This checklist creates a circuit breaker between an emotional impulse and the action of clicking the mouse. It forces logic and process back into the driver's seat. Now we come to the moment of truth, transitioning from your demo account to a live account. This is where the training wheels come off and the psychological pressure becomes real. The numbers on the screen are no longer points in a game. They represent your hard-earned money. This is the transition that breaks most aspiring traders. So we are going to manage it with extreme care. When you go live for the first time, your goal is not to make money. I will repeat that. Your goal is not to make money. Your goal is to execute your trading plan perfectly with real money on the line. To do this, you will trade the absolute smallest position size your broker allows. A micro lot or even a nano lot if they offer it. The profit or loss on each trade should be so small it's almost laughable. $1, 50 cents, 20 cents. It needs to be an amount of money that does not trigger a fear or greed response. Why? Because you are training your brain to handle the reality of live trading. You are practicing the process. You are practicing following your checklist. You are practicing journaling your emotions. You are proving to yourself that you can follow your rules when it actually counts, without the distorting influence of significant financial outcomes. Consider your first 90 days of live trading as psychological probation period. Your measure of success is not your P&L. Your measure of success is your discipline score. At the end of each day, you ask one question. Did I follow my plan 100% today? If the answer is yes, you mark a win for the day, regardless of whether you made or lost money. If you broke a rule, entered a trade not on your checklist, moved your stop loss because of fear, took a gamble, you mark it as a loss for the day, even if you got lucky and made money. After 30, 60, or 90 consecutive days of consistently following your plan, only then can you consider a marginal increase in your position size. You've earned the right to trade a little bigger because you've proven you can control yourself. If you fail to follow your plan, you don't get to increase your size. You might even need to drop back to the demo account to figure out where the psychological leak is and patch it. This entire 10-part journey, understanding the unique landscape of US Forex regulation, carefully selecting a compliant broker, funding your account, mastering the platform's tools, developing and backtesting a strategy, and building a rigid rulebook, it all culminates in this moment. It culminates in your ability to sit in front of the screen, with the market swirling in chaos, and to execute your plan with the calm, detached discipline of a professional. Trading is not a path to get rich quick. It's a business you build brick by brick, through relentless self-analysis and unwavering discipline. It's a performance art where your opponent is your own human nature. The framework we've built here gives you the tools not just to open an account but to build a career. The market presents a world of probabilities, not promises. The historical data and case studies of successful traders suggest that longevity in this field belongs to the masters of risk and the masters of self. You now have the blueprint. You have the knowledge. The path forward is not easy, but it is clear. It's a path of process over profit, of discipline over desire. The market will be here tomorrow and the day after that. The only question is, will you? Your discipline today determines your answer tomorrow. The journey starts now. Go build your process.